Great, so we'll jump right into the crypto panel right now. And before I start, I'd like the panelists to do a quick introduction about themselves and the organization they're with.
Thanks, Hui Jie. So I'm Sabrina. I'm with the HBAR Foundation. So the HBAR Foundation is the foundation that grows the ecosystem for the Hedera protocol. Has anybody, just quick show of hands, anybody in the room heard about Hedera before? Okay, not that many. So we're layer one, decentralized ledger technology. Okay, next on to you, Hayden.
Okay, thank you. HBAR is amazing, by the way, as is OKX, so just a quick thumbs up. And Hui Jie is also great. Hi, I'm Hayden. I'm the GP at Tokenize Capital. We are a venture firm intersecting in investing in blockchain technology. Really interested in the Solana blockchain. There are different layers of that chain. At the top, we have application, and then scaling, and middleware, and then the chain itself. So we see really exciting opportunities at each layer of that. A lot of really bad opportunities we're trying to stay away from, and I think have been successful, and good ones that we're chasing hard. So that's me. Thanks.
Hi everyone, I'm Gracie. I'm from OKX Singapore. It's a regulated crypto exchange here. We got our license in September last year, and we've been building for the Singapore user. Very happy to be here. And thank you for the shout out.
Perfect, great. So we'll be jumping right into questions really quickly. And right now, I think we'll be looking very much excited into crypto space, especially what happened last year after Mr. Trump got elected, and the entire space been moving very quickly as well, and growing very significantly in the areas of Bitcoin of the likes. So our first question really revolves around how has the landscape for crypto evolved since 2018? Where do you see the opportunities today? And whether is it approaching from an institutional or a family office or from a high net worth perspective, what's your view very much from the trends from then till now? And this open up to the whole panel.
Okay, I guess I'll start. So I went over my intro pretty quickly, but I've been in this space since 2018. So first as an investor, as a corporate VC, so doing more venture. So I think I can speak to the venture opportunities. Right now, we operate at the foundation, we operate a grant program, but there's also a lot of things in common with venture investments, and I also invest on the side. So maybe I will let Gracie and Hayden discuss the more trading related opportunities. But in terms of venture, it's definitely changed a lot in the past few years. It's gotten more mature. I think when I entered that space, we were one of the first corporates to be able to invest in tokens. I remember at the time also, custody wasn't even a very mature field. So, you know, like how do you manage the tokens? Like that, this was like a question that came back. And of course, since then, like many custodians that are institutional grade, there's like multi-sig, there's a lot of more sophisticated ways to handle the custody of digital assets. So that's kind of taken care of. The opportunities that were back in 2018, 19, there were, you know, of course, a lot of ICOs at the time. So, you know, you had to dodge a few bullets there. And I guess in crypto, there's always bullets to dodge because there's always, it's a very narrative based environment. And it changes very quickly. So it's very difficult, I think, for an investor to adapt and to catch the waves before they actually collapse. It's also a very cyclical market. So it's not so much about investing in the right thing, but also investing in the right thing at the right time. So typically, crypto markets are on like a 4-year cycle. And your exits will be in tokens, so that's a different exit profile as well. You typically will have, if you're investing in venture, you will get tokens into the project, maybe sometimes tokens and equity, and then you'll have a vesting schedule, right? So you have to also be able to time your exits well, and that's one of the challenges, but also an opportunity because you do get your exits faster than you do with equity. Back in, you know, in the early days of when I was investing, there were a lot of layer ones popping up. So those did pretty well, right? And then after that, no, so more layer ones, layer twos, a lot of scaling layers. So infrastructure-wise, I think there is still actually a lot to build. But there's definitely a multiplication and a fragmentation over the different layers. So then there's interoperability solutions, and it's becoming an increasingly complex and fragmented market, I would say. I see now a lot more opportunity also at the intersection between TradFi and crypto assets, but then I'll go into that maybe a little bit later. But yeah, this has been like kind of the evolution that I've seen over the past few years. It's been super interesting. It's maturing, but also there's a fragmentation that also makes it, I would say, a bit complex for an institutional investor, but institutional adoption has gone up. You see ETFs now, so even if you don't know how to handle crypto, then you're able to get some exposure as well.
I'll just add a quick comment. So first off, I agree with everything Sabrina has said, and we've been in the industry, I guess, about the same time. So everything she said is spot on. I'll just go big picture and small picture. So what we've seen in the, let's say the previous 8 years prior to today, we've seen 4-year cycles where basically everything goes up. That has been upended this past 2.5 to 3 years by just having certain sectors of the market that rotate upwards, and everything else has basically stayed flat. That I think is a reflection of the fact that the liquidity has flown mainly into Bitcoin via these ETFs. On the venture side, I talked about and Sabrina has talked about the different layers. So the application layer is on the top, the infra layer is quite close to the bottom. When you think about the billion-dollar outcomes in venture, crypto venture, I think that those really in the past have only come from the chains themselves, so the layer ones, and exchanges like our friends at OKX and others. There was one quite famous one that went under a few years ago. So those are kind of the two ends of the barbell that I see in terms of the massive outcomes. But there's a ton of infrastructure that's now popping up at the infrastructure layer and at the middleware layer that allows the existing ecosystem to scale and grow. So projects that are building real businesses, not just a crazy get-rich-quick launch a token scheme that just happen to be using blockchain as the rails. So projects like Solana Sim issuing international SIM cards using the Solana chain, Aka Finance using AI to automate how people do crypto trading. So there's a lot there. I'm excited about the future, but definitely much harder than it was a few years ago.
Well, Sabrina and Hayden have already shared so many gems that I think for me it's just, I'll just add to a point that Sabrina mentioned just now about custody. And not specific to custody, but I do feel like there's been a lot of innovation in integrating, I think particularly in integrating TradFi with crypto firms and crypto companies. And that's where we see some of the opportunity coming up. So just to name a few things, we now have fiat on and off ramps, we have custody solutions, mirroring, and this I think is actually quite important in bridging the two, right? The innovative space as well as the traditional space, and making sure that the flows are going through both ways and people have the tools they need to manage their risk, to onboard, and to do what they're used to doing in other traditional assets. So I think that's kind of where we see the greatest potential. And we have seen interest from institutions, from high net worth investors. So we believe that's going in the right direction, and we think there's going to be a lot more happening in this area.
Yeah, and we probably want to deep dive into this very much as a follow-up question. And Sabrina talked about a lot of bullets to dodge, and in the space we talk about 4-year cycles of the likes. Starting very much from Gracie and moving towards Sabrina. Maybe we can deep dive a bit into questions and say, what's the more recent trend recently, and how would some of the investors better identify, in your opinion, what would be a hype versus a more longer-term sustainable type of thing to look for within the space?
I think the investors on this panel are going to be a lot more qualified than I am to comment on that. I do think that the industry is more mature now. And the reason you're even asking that question is because there is still a lot of doubt, a lot of concern, a lot of skepticism maybe about all the different things that are coming out from the space and which areas are worth investing into and which areas you might want to steer clear of, at least for a bit, before things settle down. So I'm not going to try and make that recommendation. I'll leave it to the more qualified panelists to do that. But what I would say is that I do believe that because regulation has come in and at least for certain parts of the space, that really helps us. I believe the regulators are trying to get ahead of the innovation that's there. They're trying to figure out which areas are worth allowing to flourish and which areas they want to manage the risk more closely. And so I think that protects investors in the longer run. Obviously, there's still a lot of room to go, but we will watch what the regulators are doing and what they're saying to us. I believe that is actually a good sign of figuring out which areas are a little bit safer, which areas are a little bit more long-term in nature. The regulator coming in and providing that clarity on what the rules are for that space, those are the areas where we believe there will be long-term potential, and you might want to be looking into those spaces.
Yeah, thank you, Gracie. I think just to go back to first principles, the way that I think about blockchains is that they are ecosystems. So we're all probably familiar with Ethereum and the idea that there are smart contracts, we can build things on top of the Ethereum blockchain. So really what we're talking about, to use the language of non-crypto folks, is you're thinking about, let's say, the Apple App Store versus the Google Play Store and a bunch of different spin-offs of each of those. And so if you think about where the value is accruing in terms of those biggest app stores, which in this case I'll say are blockchains, each of those blockchains have needs for, there is an exchange that's going to be primarily focused on one blockchain. There's going to be borrowing and lending. There are different applications. So that's kind of how I think about it in terms of silos, differentiating the hype from the what's real. I mean, you can look at you can go on DeFi Llama or Token Terminal, or just ask your sons, daughters, nieces, nephews how to figure this stuff out, where the adoption is happening. So you can see, unlike in 2018 when we really only had Twitter, there's websites like Token Terminal, DeFi Llama, many others that allow you to see the number of users, the number of wallets, the number of transactions, the number of fees, the amount of revenue. This idea of the price to fees ratio now allows us to value a blockchain, and the idea that we have in investment banking of comps is no longer impossible. That used to be an impossible thing for us to quantify. So I would say if you're thinking of investing in this space, look at the blockchains, see what activity is there. Typically, the further down the chain you go, the higher the valuation, the multiple. But that's kind of how I think about it.
Yeah, so maybe to back up a little bit on that, so I like the analogy, I use it myself also, the OS, the operating system analogy, where essentially your layer 1 protocol is going to be the operating system, and then you have decentralized apps that are built on top of that. So I think what Hayden's suggesting is you look at the whole ecosystem around one specific layer 1. So in our case, it would be Hedera, or it could be, another case could be Solana or Ripple. And you kind of value the whole ecosystem based on that. That means you would be investing in the underlying token for the layer 1 protocol, so Sol or HBAR or something else, XLM, you name it, XRP. So there's the layer 1 blockchain tokens, but then there's projects on top of that. They also have their own tokens, right? So you could also invest in those. Then you have to do your due diligence separately. You'd have to look at the team. Ideally, I would suggest looking at a team that's been doxed. In crypto speak, that means the members are public; they're not anonymous. You will want to do your due diligence on things like, has the code been audited? Because hacks are very notorious in crypto. And then, so if it's a launch, and then you're coming in as a VC, then it's a different game versus if you're coming in as retail. Crypto projects do private sales, then they typically do a pre-sale. And then eventually they will go on an exchange, for example, OKX, and then the token will list there. So at different stages, you'll have different conditions, right? Either public price or either a discounted private price that may come with lookups. So of course, know that if you're coming in as a retail, once the token is public, there are holders that, it's like an IPO essentially, there are holders that, have lockups and have a lower entry point. So that's kind of what you're up against, right, in terms of making your returns. I think you were asking about like some trends, right, in terms of what are the current narratives. So maybe I can run through some of these. And it's those investment trends they cycle pretty quickly, like 6 months to a year, I would say. Depends. For example, the real world asset tokenization trend, I think it's been going on and going up for several years because it's a very strong underlying, it's a shift. But there are shorter-lived trends like NFTs, for example. I'm sure you've all heard about NFTs, right? That was 2021, 2022, maybe. Until people figured out that utility wasn't really there, and it was more of a collectible play, and how many collectibles can you really do? More recently, there was a meme, I guess, narrative, and so a lot of people started buying meme coins. Again, and not a lot of substance behind the meme coins, right? It's about the community. Is the community strong? Will it sustain itself? It's kind of a subculture type thing, and kind of, I would say, at your own risk, right? With the meme coins, they're very speculative. And then there are more, I would say, use cases that are rooted in real world adoption. So DePIN is one of them. So that's essentially the intersection between IoT, the Internet of Things, and blockchain. And then there's another one, also the intersection between AI and blockchain. So now you start having agents that can trade on your behalf. So there's a lot of trading use case with AI and agents. So that's also very interesting. I think that has legs because you'll be able to automate things and get value out of it. So yeah, those are some areas that are hot these days.
So we deep dive a little bit into some individual questions to each of the different panelists, and we'll start with Hayden. As a general partner of Tokenize Capital, how do you approach portfolio allocation across your direct investments and trading, as well as your risk management strategies when you are implementing them to your portfolios?
Sure, great question. So I think, so we as a fund, we're 90% venture, 10% liquid. It was important for us to have that 10% because, and it's a bit of a weird structure. Usually you have one or the other completely. But in crypto, sometimes you have opportunities that are just too good not to take up. The market does tend to get overbought, and at which point, you want to sell, and sometimes it gets oversold. As it appears we're almost getting to now, not investment advice. But so I think valuing different platforms is very important. So I have 90% of the capital that we have is dedicated towards venture investing. Founders, and it's changed a lot over the years. In the old days, you would just give the founder money based on the pitch deck with nothing built. Now it's a lot more important to actually have a company and actually have traction. And I've been venture investing since long before I entered crypto, and the question it always comes back to is, if this founder is successful building whatever they're trying to build, what is the degree of behavior change required by the market, by ecosystem participants to justify that? You can have something that's life-changing and revolutionary, but if it requires people who are entrenched doing things a certain way to go through a very painful transition, it's generally not going to work, and we've seen lots of examples. So focusing on the founders that are solving a real problem, that have revenue, that again are docs that have been de-anonymized, has been very important. The 10% liquid is, I try to treat that as something that's very, very, like in case of emergencies. So in true, on March 2020 style of sell-offs, I would be wanting to sell and go quite long. So it's mainly just sitting there, not doing too much, for the most part, holding a little bit of assets. On the venture side, I think it's probably about a third allocated towards the layer 1 layer, a third towards the middleware and scaling layer, and a third towards the application layer. And as you move from the blockchain itself up towards the applications, the risk increases exponentially. So the return multiple you can expect from an application that does really well is way higher than the return multiple you can expect from an exchange that does well. Exchanges take a while, and the multiple might be 10. At an application level, it might be 100 or 200 or 500 or 1,000. So obviously sizing the bets and making sure that I can actually manage. Those are some of the principles that I think about.
Great, thank you. And moving forward over to OKX Gracie, given OKX global expansion and efforts to secure licenses in Singapore, Dubai, how do you anticipate regulatory frameworks influencing the development of digital assets and Web3 over the next couple of years?
That's a great question. Thank you. I mean, our experience. So for those of you who are not familiar with the journey for OKX, we have been spending the past 2 years, 3 years maybe, going to all the jurisdictions where we operate and understanding the regulatory regime framework there, understanding what it takes for us to be able to comply with those rules, and then doing what it takes to comply with those rules and to get licenses in this jurisdiction. So Singapore, as I mentioned just now, we got a license last year. There have been other jurisdictions across the world where we've done the same. And what we've noticed is that, and we expect this to continue, what we've noticed is that every regulator will have a different, I would say, risk appetite, and also maybe a slightly different objective in what areas of that space they want to encourage to continue growing, and which areas they might want to watch and see before going in and figuring out what they want to do about that. I won't go into specifics, but that's been the general trend, and we expect that to continue. But what we know for certain is that jurisdictions, regulators across jurisdictions are going to be looking very closely at what happens in this space and designing their rules to fit. So more tailoring that to fit what is coming out of this industry. And there's always a little bit of catch-up in the early phases of a new and emerging area, and that's what we're seeing. So there will be regulatory changes. For the jurisdictions where they haven't yet launched a framework, they will be launching those frameworks. For those that have already launched it, we expect to see a lot of refinement of that framework. And that those are going to really determine how the sector evolves in each of these jurisdictions. So without going to specifics, that will define what market participants will see as opportunities in which jurisdictions, and maybe in some jurisdictions there will be more than others. So in Singapore, I think we've been very fortunate because the regulator has made very clear what the rules are, and they've also made it very clear that whether you are a crypto firm or you are a traditional institution looking to get into the space, the same rules apply. So that has, in my mind, I believe that has really created a lot of trust and a level playing field across both TradFi and crypto firms. And that's why in Singapore, we actually do see quite a lot of collaboration between the two. And in other jurisdictions where the regulators go down the same path, I expect to see the same as well.
And over to Sabrina, how is Hedera enabling real-world use cases in fintech and payments? And what impact does this have on institutional and retail adoption?
Thank you. So that's a big vertical for us, fintech and payments, and that's where I do most of my work. To back up a bit, Hedera is it's a layer 1 protocol that is very enterprise friendly. It's actually run by a governing council. So the node operation is permissioned. So we know exactly who the operators are. It's Google, IBM, about 30-something large enterprises and institutions. That allows us to really play in the fintech and payment space because when you are an institution and you want to tokenize an asset, you're going to look at your risk management. You're going to see, okay, how does the technology have outages? So we are pretty much always up. Are the nodes, any nodes run in, say, a sanctioned country? So we can confidently say no because we know all the nodes. So things like that. So that's kind of an enabler. We have so strong compliance, friendliness. We're also able to do things like freeze an account or wipe a balance, So that's rare in a blockchain. So if you're an issuer and you want to have these administrative rights, and you can. We need the throughput also, especially for payments use cases, right? So we can do 3 to 5 seconds finality usually for a transaction and up to 10,000 transactions per second. So that's kind of like the base that we're working on. And then in addition to that, specifically for payments, and also for asset tokenization, we've developed open source toolkits to enable builders and fintechs and institutions in particular to issue a stable coin. For example, we have Stablecoin Studio, which allows to at least has the blockchain infrastructure piece pretty much built and audited, including things like a proof of reserve and then the role management. And we've done the same for what we call real world assets, but so mainly for debt and equity, we have another toolkit called the Asset Tokenization Studio that has most of the smart contracts, the role management, and then a definition of the asset, definition of the jurisdiction as well. So that's allowing us to kind of support the growth of that ecosystem. We've supported a number of stable coins already, and then we have many more in the pipeline. As well as on the asset, the digital asset side, we've tokenized money markets from like Aberdeen, BlackRock, State Street, recently Fidelity, and such. And so it's going. I guess the flywheel has kind of started spinning for us, I would say.
Yep. So I think very much as a follow-up question to this, and we talk a little bit about TradeFi and of the likes as well. How do you see this very much integrating into the entire system? And how do you foresee this very much? What role will your organization play in this, and what will be the impact into the industry?
So I'm very much at the intersection between TradFi and blockchain. So I would say the first use case that kind of started touching TradFi is stablecoins. So stablecoins are essentially an on-chain representation of fiat. Usually it's a mix between collateral of fiat and then highly liquid assets like treasuries or money market funds. The initial use case for stables was really just, and they've been around forever, like maybe 2013 or 14, was trading in and out of crypto. And that was the first product market fit, but now actually stablecoins are going into the TradFi world, being accepted for payments, using for cross-border payments, FX, all these areas that have high fees and also friction. So that's a big one, and then and that's the beginning of the onboarding of capital markets on chain. And so started with stable coins, and then other assets like treasuries, money markets, and then real estate, everything. So yeah, it's kind of hard to cover it all, but that was kind of like the starting point.
Hayden, would you like to take that?
Yeah, so I think that the TLDR here is that adoption is happening. These blockchains are being used by traditional market participants to put things on chain. Sabrina has talked a lot about RWAs. I think that's something that's very exciting and very clear. I think that what you'll start to see is a bit of a shift. I mean, there will be traditional use cases of blockchain technology where you might be dealing with a bank or you might be dealing with a broker. You don't know you're using blockchain. And then there's going to be everything else. Within the crypto space, I think there will be a revaluation of a lot of these crazy, get-rich-quick tokens that'll go down, and the ones that comply with the laws will go up. So I'll just give a quick plug. So Sabrina is from HBAR. They are a home of innovators. So if you're innovating, you want to build some cool stuff, they're the ones to go to. OKX is the best exchange I've traded on, and they're open for business, and I'm here to invest in great assets, and we're open to talk to new investors as well. But I'll pause there and let, same question to Gracie? Okay.
I touched on this, well, thank you so much for the plug. I touched on the TradFi integration earlier in I think one of the earlier questions, and I mentioned specifically custody. I mentioned on-ramping, and I believe all of these are bringing us in a direction where eventually it's going to be seamless. And if you're an investor, I believe that's good news, where you don't have to think about. And just now, Hayden, you also mentioned, right? Sometimes you want to make sure that there isn't a big behavioral change required for people to adopt a new technology, a new asset class, or add something to their portfolio. And that's what some of these integrations aim to do. So if you're an investor, you can be holding your US treasuries or holding your fiat, and that can count towards collateral for your trades on an exchange when you're trading crypto. So all of these different areas where TradFi and crypto companies are working together really aim to make that experience seamless for investors. And that's where I think the biggest improvement from our perspective as an exchange is coming.
So time really flies, and we would end with a last question, which is if there's one key thing that each of the panelists would like to leave the audience with, what would you so-called give your take on to the rest of the audience here?
Okay, I'll start. So you can't ignore that this asset class is here to stay, and I'm not telling anyone that they should go, mortgage their house and chop off their left leg to put money into the space. But I would suggest respectfully that the correct allocation to this asset class is not zero. So how you do that and the way you do that and your outlook and your timeline, you can work on that and figure it out. But this is not something that you should have zero. That would be my message.
And I'm going to add that it's going to be so pervasive because we're onboarding all the capital markets now, right? Eventually, even an asset that you used to buy off chain, you will be buying it on chain, maybe without even knowing. So to Gracie's point about the user experience, blockchain for the sake of blockchain is going to disappear. Like it's going to be under the hood, and no one's going to know that things are on chain even when they are.
I was also going to say crypto is here to stay, but you've already said that. So I'll add a little bit more. It's here to stay, and I do believe it's going to be growing in a more sustainable and responsible direction. So some of the horror stories of the past, I think, I'm hoping were in the past, and this industry is evolving, and we see more and more trust, more and more security, more and more safety, more and more integration with the established players in every single market that we operate. So I think it's here to stay, and it's going to be growing in the right direction.
Perfect. Thank you very much to all expert panelists and the wonderful audience. Thank you. Thank you.